Silver market analysis, February 2026, when paper prices collapsed but physical metal disappeared. January 31st, 2026, silver futures crashed 31% in a single trading session, the largest one-day decline in 46 years. Billions erased from precious metals markets within hours. Yet something unprecedented occurred. Bullion dealers across 3 continents shut down operations, not because demand collapsed, but because they couldn't source a single ounce of physical silver at any price. Shanghai markets showed silver trading at $122 per ounce, while New York COMEX settled at $78, a 56% price difference between the same metal in the same 24-hour period. When paper markets crash while physical metal disappears, one of these markets is lying. Welcome to Silver Collapse Coming, where we provide strategic economic analysis for experienced investors and business professionals who understand that market events often signal deeper structural shifts long before they become obvious. If you're someone who values substantive financial intelligence over entertainment, someone who's built wealth through informed decision-making rather than speculation, we invite you to subscribe to this channel. We don't chase trends, we examine the fundamental forces that create them. Before we continue with today's analysis, we'd appreciate knowing where you're joining us from today. Which country or region are you watching from? Your perspective adds valuable context to our community of strategic thinkers. On January 30th, 2026, financial markets received news that would trigger one of the most violent precious metals sell-offs in modern history. President Donald Trump announced his nomination of Kevin Warsh as the next chairman of the Federal Reserve. The reaction was immediate. Silver futures opened the following trading session under intense selling pressure. By the close of January 31st, silver had plummeted 31.4% to settle at $78.53 per ounce. This represented the steepest single-day decline since March 1980, when the Hunt brothers' silver manipulation scheme collapsed. Gold fell alongside silver, dropping 11.37% to $4,913.90 per ounce, the largest gold decline in over 4 decades. Traders scrambled to understand what was happening. The catalyst appeared straightforward on the surface. Kevin Warsh brought a specific reputation to the Federal Reserve nomination. During his previous tenure as a Federal Reserve governor from 2006 to 2011, Warsh consistently opposed quantitative easing measures, even during the depths of the 28 financial crisis. When most policymakers advocated unlimited monetary stimulus, Warsh argued against expanding the Fed's balance sheet. His public statements emphasized the long-term dangers of excessive money creation. Market participants interpreted his nomination as a signal that the era of accommodative monetary policy might be ending. Higher interest rates increase the opportunity cost of holding precious metals. Gold and silver pay no interest or dividends. When government bonds offer attractive yields, investors rotate away from non-yielding assets. A stronger dollar also pressures commodity prices. On January 30th, the dollar index rose 0.79%, its strongest single-day performance in 6 months. Most commodities are priced in dollars globally. When the dollar strengthens, it makes those commodities more expensive for international buyers. Demand typically decreases, pushing prices lower. But the trading mechanics amplified what might have been a normal correction into a historic collapse. Speculative positioning in silver had reached extreme levels throughout late 2025. According to commitment of traders data published by the CFTC through January 23rd, net long positions in silver futures had climbed to record highs. Hedge funds, commodity trading advisors, and retail speculators had all crowded into bullish silver bets. Many of these positions were heavily leveraged. Leverage magnifies both gains and losses. When prices began falling, margin calls triggered across the market. A margin call occurs when an investor's account value drops below the required minimum. The broker demands additional funds immediately. If the investor cannot post more capital, the broker forcibly liquidates the position. This forced selling creates additional downward pressure on prices, which triggers more margin calls, which creates more forced selling. The cycle feeds on itself. Exchange-traded funds experienced unprecedented stress. The iShares Silver Trust, the largest silver ETF, declined 31% on January 30th, its worst day on record since inception. ProShares Ultra Silver, a leveraged ETF designed to deliver twice the daily performance of silver, fell more than 62%, also a record single-day loss. Morgan Stanley's quantitative trading desk published analysis that evening. They calculated the sell-off represented a 13 standard deviation move for the iShares Silver Trust, a 9 standard deviation move for the iShares Gold Trust. In statistical terms, events beyond 6 or 7 standard deviations essentially never occur under normal market conditions. These were not normal conditions. Matt Maley, chief market strategist at Miller Tabak, told financial media that the decline appeared driven primarily by forced selling rather than fundamental repositioning. He explained that leverage built up during the 2025 rally created cascading margin calls once prices began falling. Morgan Stanley estimated that leveraged ETFs required massive rebalancing. The iShares Silver Trust needed to sell approximately $3.5 billion worth of silver. The iShares Gold Trust needed to dispose of roughly $650 million in gold, all within a compressed time frame. This institutional selling overwhelmed available bid liquidity. The technical damage was extensive. Silver had reached $112 per ounce on January 26th, just 5 days earlier. The decline to $78.53 represented a 30% correction from that recent high. By February 2nd, silver had recovered modestly to trade around $83 per ounce, but it remained well below the levels that had prevailed throughout most of January. Analysts across Wall Street published research notes attempting to explain the magnitude of the move, most focused on the Warsh nomination, dollar strength, and technical factors. Yet beneath this paper market chaos, a completely different narrative was unfolding. Physical silver markets were telling a story that contradicted everything the futures market suggested. While paper prices collapsed by 31%, physical dealers worldwide reported they could not source inventory at any price. While traders in New York celebrated profitable short positions and Wall Street analysts published bearish research reports, something extraordinary was happening in Shanghai. Physical silver markets across Asia were behaving as if the January 31st crash had never occurred. On February 1st, the Shanghai Gold Exchange reported spot silver trading at $122.13 per ounce. COMEX paper silver had settled the previous day at $85.33. The mathematical reality was stark. Shanghai physical silver commanded a premium of $36.80 per ounce over New York futures, a 43.13% markup. This was not a temporary glitch or data error. Chinese retail investors logged onto JD, come to us, China's largest e-commerce platform, searching for physical silver bars. The listings they found showed prices of $160.35 per ounce, nearly double the COMEX paper price, a 91% premium. But when the same commodity trades at twice the price in one market versus another, something fundamental has broken in the price discovery mechanism. Gold occasionally experiences modest premiums during supply disruptions, perhaps 5% in times of stress, maybe 10% during extreme events. Silver has historically traded with small regional variations, a few percentage points here or there. But an 80% to 91% structural decoupling between paper and physical prices, sustained across multiple global regions, had never occurred in modern commodity markets. The pattern extended beyond China. In Japan, buyers who managed to locate inventory paid $130 per ounce on January 1st. COMEX futures that same day settled at $72, an 80% premium. In the United Arab Emirates, the same dynamic prevailed. Physical silver, when available, traded at $130 per ounce, while Western exchanges showed $72. Indian bullion dealers reported customers offering 5 per ounce premiums above COMEX prices just to secure physical delivery. Chinese buyers contacted foreign suppliers throughout late December 2025 and early January 2026. They offered $8 per ounce premiums to anyone who could ship physical metal to mainland China. Physical queues formed outside bullion dealers across China, Japan, and Taiwan. Not the orderly lines of normal business. Desperate crowds of retail and institutional buyers scrambling to secure metal before supplies vanished entirely. Then the dealer announcements began. Bullion Star, a Singapore-based precious metals dealer with global operations, published a trading update on their website. The statement was unusually direct. It remains uncertain whether we will be able to acquire any additional silver inventory at all. Throughout this period of market revaluation, dealers have witnessed extreme and unprecedented physical demand. At the same time, replenishment options have become increasingly scarce, with physical metals drying up and mints operating under enormous backlogs. The statement continued with a pointed observation. In such an environment of constrained supply and sustained physical demand, sharp price declines in the paper markets are difficult to reconcile with the realities of the physical precious metals market. Bullion Star was politely saying that paper prices no longer reflected actual supply and demand. Golden State Mint in the United States faced similar constraints. They suspended all silver sales for weekend operations, not because demand had collapsed, because they could not secure metal to sell. This marked only the second time since the March 2020 COVID-19 panic that Golden State Mint had shut down due to supply constraints. Baird & Co. in the United Kingdom carried particular significance. As Britain's largest precious metals refiner and retail dealer, Baird processes substantial volumes of silver for both industrial clients and private investors. They suspended online sales entirely. If a major refiner cannot maintain normal operations, The problem exists at the source level, not merely at retail distribution points. The supply deficit data provided context for these shortages. Metals Focus, an independent precious metals research firm, published projections for 2025. They estimated the silver market would face the deepest supply deficit on record, approximately 295 million ounces when ETF flows were included. But the problem extended beyond a single year. The cumulative silver deficit since 2019 had reached 1.3 billion ounces. More than one full year of global mine production simply gone. Industrial demand had grown relentlessly. Solar photovoltaic panel manufacturing consumed record quantities of silver in 2024 and 2025. Each panel requires silver paste for electrical conductivity. As solar installations accelerated globally, silver consumption accelerated with them. Electric vehicle production increased silver loadings per vehicle. Electronics manufacturing reached all-time demand highs. Artificial intelligence infrastructure build-out required massive silver consumption. Servers, data centers, power management systems all require silver for electrical connections, yet mine production remained essentially flat. Mexico produces approximately 5,000 tons annually, representing 20% of global supply. Peru, China, Russia, Bolivia, Australia, Chile, and Poland make up the remaining major producers, but mining output faces increasing constraints. Environmental compliance requirements led to temporary shutdowns at several major Mexican operations. Labor disputes in Peru, Chile, and Bolivia disrupted production schedules. Infrastructure limitations restricted processing capacity expansion in developing regions. Silver recycling contributes roughly 20% of annual supply, but recycling cannot offset a 295 million ounce annual deficit. Then China made a strategic decision that changed everything. On January 1st, 2026, Beijing implemented the most aggressive precious metals export controls since their rare earth restrictions. China reclassified silver from an ordinary commodity to a strategic resource subject to government licensing. Only 44 companies received authorization to export silver for 2026 to 2027. This established government gatekeepers over approximately 121 million ounces of annual exports. That represents 60% to 70% of refined silver traded globally. When the world's second largest silver producer restricts exports, global supply chains face immediate pressure. The result was paradoxical. Paper markets crashed 31% in a single session. Physical buyers could not acquire metal at paper prices. The commodity exchange that had governed silver pricing for decades was beginning to show cracks in its foundation. COMEX, the New York-based metals exchange operated by CME Group, reported silver inventories of 415 million ounces by late January 2026, the lowest level since March 2025, a decline of 34 million ounces from recent peaks. Financial media reported these numbers as routine inventory adjustments. But experienced commodity traders understood that headline inventory figures concealed a far more serious situation. COMEX divides its silver holdings into two distinct categories. The distinction matters enormously. Eligible inventory consists of silver bars stored in CME-approved warehouses. These bars meet exchange specifications for weight and purity, but eligible status does not mean the exchange controls that metal. The silver may belong to mining companies using the warehouse for storage. It may belong to industrial manufacturers maintaining supply buffers. It may belong to wealthy individuals storing personal holdings in secure facilities. The CME has no authority to commandeer eligible inventory for contract settlement. Registered inventory tells a completely different story. Registered silver has been officially delivered onto the exchange. The owner has received a warehouse receipt. That metal stands available for delivery against futures contract obligations. Only registered silver can settle expiring contracts. And registered inventories were vanishing at an accelerating pace. Since September 2025, registered supplies experienced unprecedented drawdowns. Between early January and mid-January 2026, a 7-day period witnessed the physical withdrawal of 33.45 million ounces. Roughly 26% of COMEX's registered inventory disappeared in a single week. Professional traders who monitor these flows daily recognize the implications immediately. When traders examined the composition of registered inventories more carefully, the situation appeared even more precarious. Industry sources indicated that significant portions of what COMEX classified as registered silver were either non-eligible due to technical specifications or already encumbered through leasing arrangements. The pool of truly deliverable, unencumbered, immediately available silver was substantially smaller than official statistics suggested. Then the delivery behavior changed in ways that veteran traders had never witnessed. Futures markets operate on a well-established principle. Most participants close their positions before contract expiration. They either sell to exit or roll their position forward to a later delivery month. Physical delivery represents perhaps 1% to 2% of total futures activity under normal circumstances. The system functions as a financial hedging and speculation mechanism, not a physical distribution network. January 2026 shattered that pattern. Traders refused to wait for standard delivery periods. They paid premiums to pull deliveries forward by several weeks. They demanded physical bars immediately, not in March or April. On January 7th alone, holders of 0.624. January 2026 silver contracts took delivery of 8.1 million ounces. JP Morgan Chase issued 99% of that metal to numerous different recipients. But the unusual aspect was what happened to open interest. Normally, when contracts are delivered, open interest decreases by an equivalent amount. Instead, open interest for January actually increased by 131 contracts that day, ending at 155 total. February contracts increased by 164, ending at 423. Market participants were using COMEX as a physical procurement mechanism, not as a price hedging tool. They wanted metal, not financial exposure. The March 2026 contract represented the most critical stress test approaching. While January open interest stood below 4,000 contracts and February hovered around 1,000, March showed over 118,000 contracts still outstanding. Each contract represents 5,000 ounces. Simple mathematics revealed the scale of potential demand. 118,000 contracts multiplied by 5,000 ounces equals 590 million ounces. COMEX registered inventory could not possibly satisfy such demand. Even if only 10% of March contract holders demanded physical delivery rather than rolling forward, the requirement would be 59 million ounces. If 20% stood for delivery, 118 million ounces. Registered inventory had already been depleted to dangerously low levels. Additional data points confirmed the physical stress. Silver lease rates, the cost to borrow silver for short-term needs, spiked to extraordinary levels. Rates reached 50% to 200% annualized during periods of acute scarcity in late 2025 and early 2026, when someone must pay 100% annual interest to borrow silver for 30 days. Genuine physical shortage exists. This is not financial market volatility. This is commodities disappearing from available supply. The futures curve structure provided additional confirmation. Silver entered its deepest backwardation since 1980. Backwardation occurs when immediate delivery prices exceed future delivery prices. The normal commodity curve shows higher prices for later delivery because storage costs, insurance, and financing create carrying charges. An inverted curve signals desperate immediate demand. Front-month March contracts traded several dollars above June and September contracts throughout January 2026. This pricing structure incentivizes immediate delivery. Why would anyone roll their position to June at $80 when March offers $84? They wouldn't. They take delivery in March, which places enormous pressure on registered inventory. The CME Group responded with administrative measures. On January 28, 2026, they raised margin requirements for precious metals futures. 3 days later, on February 2nd, they raised them again. Gold margin requirements increased 33% from previous levels. Silver increased 36%, platinum increased 25%, palladium increased 14%. A silver contract that required approximately $25,000 in margin before the increases jumped to around $66,000 after January 28th. The second increase on February 2nd pushed it even higher. CME officials cited the need for better risk coverage for clearing firms, but market participants interpreted the timing differently. 2 margin increases within 72 hours during a period of extreme volatility had a predictable effect. It forced over-leveraged long positions to liquidate. Traders who could not post additional collateral saw their positions closed by their brokers. Perhaps most revealing was the institutional positioning shift. JP Morgan Chase, historically one of the largest short sellers in silver futures, reversed course dramatically in January 2026. The first delivery report of the year showed JP Morgan aggressively standing for maximum physical delivery. When the world's largest bullion bank shifts from shorting silver to accumulating physical metal, it signals where they believe true value lies. The events of late January and early February 2026 forced a fundamental question that most market participants were unwilling to ask. Which market tells the truth? 2 completely contradictory realities existed simultaneously. In the paper reality, futures markets crashed 31% in a single session. Margin requirements doubled within 72 hours. The Kevin Warsh nomination signaled tighter monetary policy ahead. The dollar strengthened significantly. ETFs experienced record liquidation volumes. In the physical reality, silver had posted 9 consecutive months of price gains through December 2025, the longest winning streak in recorded history. Gold achieved 7 consecutive monthly gains, also the longest streak ever documented. Dealers shut down operations because they could not source inventory. Shanghai premiums reached 43% above COMEX. Chinese e-commerce platforms showed 91% premiums. COMEX registered inventories were being depleted at unprecedented rates. One of these realities would eventually overwhelm the other. The question was not if, but when. The Kevin Warsh nomination provided important context for understanding monetary policy trajectory. Initial market reactions treated Warsh as a pure inflation hawk who would aggressively raise interest rates, but his actual policy record suggested more complexity. Warsh supports interest rate cuts when economic data warrants such action. He is dovish on rate policy, but he advocates strongly for balance sheet discipline. He opposes unlimited quantitative easing, even during crisis periods. This combination creates an unusual dynamic. Rate cuts typically support precious metals by lowering the opportunity cost of holding non-yielding assets. But balance sheet discipline limits the liquidity injections that have historically driven asset price inflation across all markets. The net effect depends on which force dominates, lower rates pulling precious metals higher, or tighter liquidity constraining speculative buying. Recent economic indicators complicated the analysis further. The Financial Conditions Index declined to 98.3 by late January 2026, the lowest reading since early 2022. Financial conditions had loosened substantially since the Federal Reserve began cutting rates in September 2024. Cumulative cuts totaled 175 basis points over that period. The dollar had declined 12% over the prior 12 months despite recent strength. Investment-grade credit spreads reached their tightest levels since 1998. All of this suggested that financial conditions had essentially returned to pre-rate hike levels. Markets were liquid again, credit was flowing. Asset prices could rise once forced liquidation pressures subsided. Yet inflation remained problematic. The Producer Price Index for January 2026 showed unexpected strength. Consumer Price Index data remained elevated between 3.2% and 3.5% through late 2025, still well above the Federal Reserve's 2% target. If Warsh prioritized inflation control over employment concerns, as his historical record suggested, monetary policy might remain tighter than markets had expected during the 2025 precious metals rally. Geopolitical developments added another variable to the equation. United States tensions with Iran escalated sharply in late January 2026. President Trump deployed additional troops and naval assets to the Middle East region. Iran's supreme leader issued a public statement that carefully balanced deterrence with restraint. We will not start a war, nor do we wish to attack any country, but our people will deliver a powerful blow to anyone who attacks them. Middle East instability has consistently driven institutional safe haven allocations toward precious metals. Regardless of short-term paper market volatility, the strategic resource reclassification represented a paradigm shift that many Western analysts were still failing to appreciate. The United States officially designated silver as a critical mineral in 2025. Russia confirmed central bank allocations for precious metals reserves, including silver. China's export licensing system now treated silver as a strategic national resource, not a simple industrial commodity. When major economic powers view silver through a strategic security lens, market dynamics fundamentally change. Government stockpiling begins competing directly with industrial and investment demand. Export restrictions fragment previously integrated global supply chains. Price discovery mechanisms may shift away from centralized futures exchanges toward bilateral negotiations and regional markets operating under different rules. The ETF structure contained vulnerabilities that few retail investors understood. Most silver ETFs function through complex arrangements. Authorized participants create and redeem shares. Custodians hold the metal, often through sub-custodians in various jurisdictions. Leasing agreements allow the metal to generate yield. Much of the silver exists as unallocated, meaning specific bars are not assigned to specific shareholders. Under normal market conditions, this system operates smoothly and efficiently. Under physical supply stress, it does not. When physical silver becomes genuinely scarce and lease rates spike, authorized participants may become unwilling or unable to source metal for ETF creation or redemption processes. ETFs can begin trading at persistent discounts or premiums to their stated net asset value. Redemptions may be suspended temporarily or indefinitely. Cash settlement may replace physical delivery. In extreme squeeze scenarios, ETF shares might continue trading while the underlying metal effectively disappears from accessible markets. The March 2026 delivery period would serve as a critical test. If substantial numbers of contract holders demanded physical delivery rather than rolling positions forward. And COMEX registered inventory could not satisfy that demand. Several outcomes became possible. The exchange might declare force majeure, suspending normal delivery obligations. Cash settlement at administratively determined prices could replace physical delivery requirements. Delivery delays might extend weeks or months beyond contract specifications. Significant premiums for immediate physical delivery versus paper contract pricing could emerge permanently. Each of these outcomes would further erode confidence in paper silver as an effective price discovery mechanism. Historical precedent suggested that prolonged dislocations eventually resolve in favor of physical markets. The Hunt brothers episode of 1979-1980 saw temporary divergence before regulatory intervention. The 2008 financial crisis created brief dislocations that eventually corrected. But the current situation differed fundamentally in both scale and structural nature. This was not speculative excess by individual wealthy actors trying to corner a market. This was industrial demand growing faster than mining production could accommodate. This was government strategic resource designation at the highest policy levels. This was export restrictions imposed by major producing nations for national security reasons. This was cumulative supply deficits exceeding 1.3 billion ounces accumulated since 2019. For business decision makers and institutional portfolio managers evaluating precious metals exposure. The silver market of February 2026 represented far more than routine trading volatility. It represented the early stages of a fundamental commodity repricing, driven by supply-demand imbalances that monetary policy tools cannot resolve. Whether silver ultimately reaches $100 or $120 per ounce during 2026 depends largely on how quickly physical market reality overwhelms paper pricing mechanisms. The timeline remains uncertain, but the direction of eventual resolution appears increasingly clear. When paper markets can crash 31% while physical dealers cannot source inventory at any price, the paper market has lost its authority to determine true value.